So we spent half an hour pleasantly thinking about the future, but I'm here to think about the present and how much the present is still like the past. I want to talk about the things at a much higher level than most of the things we've talked about this week so far. We've mostly gone down to communications protocols, how we can make sure that transactions are secure, all of those kinds of things. It's low-level stuff, but I want to move up a bit and consider some of the problems that we're having to confront at the moment in implementing instant payment systems, particularly instant payment systems that cross borders. Okay, so let me start. I'm the principal architect at the Mojaloop Foundation. My background is in software engineering, but about 15 years ago, I started to do things in the world of payments. So I'm by no means a payment expert. And this is, you must think of me as a kind of wide-eyed explorer of the world of payments, looking around and saying, oh my goodness, do they do things like that? Why do they do that? But I'm going to share those thoughts with you now. So let me talk first of all about the Mojaloop Foundation. The Mojaloop Foundation is a non-profit organization originally supported by the Bill and Melinda Gates Foundation, and it's based on the principles developed in a project with which Costa was intimately involved, the Level 1 project. And the Level 1 project was designed to say, in general, what are the characteristics that a financial system should have if it's meant to help primarily poor people. And it wound up with a series of principles, a series of learnings from existing financial systems for the poor, and a series of, I'm going to call them hints, suggestions as to what sorts of things people might want to consider when they were implementing payment systems for helping the poor. So what the Mojaloop Foundation does is it provides software tools and support for people who want to implement inclusive instant payment systems. Like all right-thinking people, we produce open source software. Anyone can download it and make whatever changes they want to it. And our view on open source and financial systems, going back to a point that was made in the main session this morning, is that the more eyes there are on a piece of code, the more likely it is to be secure. We think that a wide community of people looking at code and trying to find things wrong with it gives you a much better answer than a small team in a commercial product whose job may be to discover problems, but they are only a small team. So our view is the wider the better. And we also provide support for people who are implementing inclusive payment systems. That includes helping them design the way in which their payment system is going to work, helping them to implement it. And one of the things we discovered very quickly in this environment is that the technical side of payment systems is really not too much of a problem. I mean, there are problems associated with it, but it's not the technical side that's the problem. The problem is the financial community, the regulators, the existing financial institutions, all of those people, getting them to understand what needs to happen and, worse still, to make informed decisions about exactly how they want to do these things is the most difficult part. We are currently engaged in developing a system for COMESA, which is a regional group of countries in Africa. Goes all the way from Tunisia in the north down to Eswatini in the south. And there are 21 countries in this union. And that essentially means that we have 21 regulators that we have to get to agree on certain key points about the system. So that's an important part of the work we do. And we're also part of the Digital Public Goods Initiative. We think that payment interconnection systems, such as we provide, are a fundamental building block for making sure that other systems, health systems, education systems, all of those kinds of things, can reliably make and receive payments for everybody in a given jurisdiction. So that's what we do. Now, I want to look at two aspects of international payments in this talk. The first of them is what I'm going to call the financial aspect. Now, let me think about how a Rafiki international payment might work. Let's suppose I've got a bank, doesn't matter where it is, and I want to send some money to my friend Julie, who is in Singapore. So my bank is denominated in sterling, Julie's bank is denominated in Singapore dollars. So the problem is, how do I get those funds? Well, I start off with a couple of intermediary banks through which the payment will travel. And the first thing I do is I pair with the intermediary bank 1, and I transfer in pounds through Rafiki from Ledger 1 in my bank to Ledger 1 in the Interledger bank. Now, what the intermediary bank can do is it can convert that payment to Singapore dollars, let's say. We'll get on to how that happens in a bit, but we assume for the moment that when the payment comes out of Ledger 2 at intermediary bank 1, it's denominated in Singapore dollars. It goes to intermediary bank 2 in Ledger 1, still in Singapore dollars. Oh, sorry. And finally, it gets to Julie's bank. And we'll see there are 3 Rafikis involved as intermediaries in that payment. The other important thing to note is that the Rafikis are always transacting in the same currency. If there's a currency conversion, it happens inside one of the banks. It's not immediately available to the Rafiki. Okay, so if we ask what happened here, I lost my money, my bank took it. Julie got her money, her bank's lost it. So Julie's bank paid her some money, she can walk out, go and spend it on something, it's gone. Everybody else just got a promise. Now, here's a promise, here's a promise, here's a promise. And what the Interledger protocol and the Rafiki that's built on top of that do is they make sure that these promises can be trusted, that these are real cryptographically enabled promises, and they provide evidence that one bank can go to another bank and say, you did make this promise, didn't you? You said you would. But that's not the same as actually doing it. So how are those promises kept? Well, either through a system that's trusted by both parties. Traditionally, this is what's called a real-time gross settlement system or a clearinghouse. And it's generally operated, though not always, by the central bank of a jurisdiction or a region to which both the parties belong. Could also be a distributed ledger, which is trusted by both parties. Could be a stable coin or something like that. Or through a bilateral relationship between 2 institutions who trust each other. It's called a correspondent relationship or correspondent banking. And the Interledger protocol sits somewhere, I think, between those 2. So it manages the relationship between 2 different representations of what is effectively the same ledger, rather like a correspondent relationship. But it also specifies that both of the parties to an interledger payment should have agreed on a settlement model which they both trust. Now, you'll notice that I'm using the word trust a lot here. And the financial world is built on trust. And one of the activities that I think we're engaged in here is saying, how can we schematize trust? How can we convert trust between institutions and between people into something which is verifiable? So, what happens in the system trusted by both parties, real-time gross settlement or whatever it might be, is that money is transferred in that system, and both of the parties regard that as equivalent to either having or losing their money. They don't have to regard it as that, but if the system is to work, then that's what they have to say. Now, the problem is that there are no roses, at least in the world of finance, without thorns. And if you're a real-time gross settlement system or a clearinghouse, these are typically designed for high-value, low-volume payments. They're designed for banks transferring funds between each other, which are netted out at the end of day. And typically, as I say, they will be large sums, and there won't be that many of them. Now, as you know, all of the systems that we're talking about, that Joran's just been talking about, are low-value, high-volume systems. So they are inherently unsuitable for clearinghouses or real-time gross settlement systems, at least as they are at present constituted. Per transfer fees tend to be high, and that's okay because for high-volume payments, they don't form a great proportion of the payment. But as you can imagine, for a low-value payment, having a transaction which costs a lot of money, or even a medium amount of money, is no good at all. And availability is typically low. Now, most real-time gross settlement systems in the areas that we're interested in Africa, in South America, those places, the real-time gross settlement systems keep banking hours. They come online at 9 o'clock in the morning, they go off typically about 4 o'clock in the afternoon, and they definitely don't work weekends and public holidays. So if you imagine a real-time payment system which is running 24/7, it may well be 3 days. So a payment that's actually made, let's say Friday afternoon at 4:15, won't be settled until Monday morning at 9 o'clock, which is a problem. The DLT, the problem here is that you need to be readily converting between the DLT ledgers and the fiat currencies. Sorry, fiat is just a word for money. But people in the finance world like to talk about fiat currencies. It kind of sounds cool, don't you think? Anyway, the problem here is if I've got a stable coin or any form of blockchain-related currency, at some point, unless everybody is using it, I've got to convert that to a real currency. It might be Malawian kwacha or whatever it might be. And that means I've got to find someone who is prepared to buy those coins and give me Malawian kwacha. So the problem hasn't gone away if you're using a blockchain. Correspondent banking, on the other hand, it's a private arrangement between banks, and therefore, how could the interests of consumers possibly not be served? Costs are unregulated, typically, and they're frequently very high. They're designed like RTGSs for high-value, low-volume payments, because that's where the money is. And exchange rates are high outside highly traded corridors. Now, by highly traded corridors, I mean, if you want to get a quote for converting US dollars to euros, or euros to GB pounds, no problem. If you want to get a quote for converting from, I don't know, Egyptian pounds to Zambian kwacha, that's a problem. Because somewhere, somehow, you've got to find people who will sell or buy those currencies, and there aren't that many of them. So exchange rates are typically high. And the availability of correspondent banking, again, may be low, because it depends on when those banks are actually working and their systems are available, that the payments can actually be processed. So, our conclusion, well, I'm going to say my conclusion is, DLT methods are potentially useful, but really they're useful in a context which doesn't yet exist. A DLT is really useful if everybody accepts it as a currency, if the end users accept it as a currency. Now, you'll have heard obliquely, I think, from a number of people who talked yesterday and today that one of the problems that we have when we're trying to include people financially is that people are conservative in relation to their finances. This is partly because for poor people, finances are very much more important than they are for us. We heard people saying in Costa's talk, in the questions after Costa's talk, they've been scammed. And it's happened to everybody, I think. And most of us, most times, we say, won't make that mistake again, and we pick up ourselves and go on our merry way. But for the poor, that can be the difference between keeping their heads above water and going under financially. So they are very conservative. And one of the problems that we have is convincing people that a digital payment system is as reliable as cash, which they're used to. That's our competition. Now we have to convince them of that, and we have ways of doing that. We're developing ways of doing that, but they are not yet very advanced. And therefore there are problems with take-up in payment systems for the poor. You can imagine those problems being multiplied by a large amount if you want to persuade people to use a DLT, a stable coin, or something like that. So they say, digital payments, well, I kind of understand that because it kind of represents cash. But a blockchain, a stable coin or something, is very hard to understand. It's very hard for me to understand. So there's a problem there. The chances of our getting people to accept a stable coin instead of a fiat currency are, I think, reasonably low. We think of cash as being something which is acceptable everywhere. We forget that that's quite a recent thing. If you look at the history of paper money, then 150 years ago, there were directories published of all of the different banknotes that you could get in all of the different issues, and against each one was said what kind of a discount you should apply if someone offers you this bill. So if you offered a $20 bill to someone in, let's say, 1850s New York, they would look at it and say, I'll give you $15 for that, or I'll give you $10 for that, or that isn't worth anything at all. And everybody had to know about that in order for cash to work. It took a long time and a lot of effort for people to start to trust cash. We kind of tended to think, that it was always like that. People always just trusted cash, but it wasn't. It's a historical process, and that trust had to be built. And we are going to have to build that trust. We have to build that trust in relation to digital payments, and still more if we want people to use something like a stable coin, which is not the currency of their country. So traditional methods then, they're expensive per transfer. They're unavailable for significant periods. What's the solution? Well, what everybody does is we sum up all the obligations and settle them in a block. We say, okay, all of the transfers that happen between, let's say, 4 o'clock Friday and 9 o'clock Monday morning, we'll sum them all up, net them out, and then we'll just settle those on the Monday morning. And that's the way in which most payment systems work. It's called deferred net settlement. Now, the problem with that is the problem of time. Now, in a single currency payment, participants will need to provide working capital, at least they will in the Mojaloop system. In a Mojaloop system, we insist that people pre-fund their transfers so that we can guarantee that they will be able to settle them when it comes round to it. And obviously, the more transactions are there, the more working capital, which is what the liquidity is, they will need to provide. And that's particularly problematic if, in some cases, they might have to wait 3 or 4 days. In the rest of the time, they only have to wait a day. The quicker we can settle, the more often we can settle, the less working capital. And this becomes a major problem in a multi-currency payment because exchange rates can change over time. Now, I would be the last person to say that having exchange rates the subject of speculation by financial institutions is a bad thing, but it is a very bad thing. Essentially, it means that people in the financial community are constantly making bets about what's going to happen about currencies. And that means that currencies go up and down. You can see that. If you look at exchange rates in WISE or whatever banking system you use, all the time over the course of a day, the exchange rate is changing, not by much, but it's changing. And there are some cases in less traded currencies where exchange rates can change by a great deal. I noticed one particular case where the Bank of Egypt's exchange rate changed by 40% in one day. So this is a problem. Now, if people are going to use a system, then you've got to offer them a competitive exchange rate when the payment is made. If they can't get a competitive exchange rate, they'll go to a money changer, they'll go to some other way of getting those funds. But the problem is that the funds are required when the net liability is settled. Now, with pre-funding, that means that when people do the pre-funding, they will buy that currency at a particular rate. When they come to pay it, then that rate may have changed. And this is called exchange rate risk. And it's a major problem for cross-border payments. Now, one of the great happinesses of PCH is that they have a St. Christopher who can carry the miraculous child, PCH, safely across the river of currency flows. And that's called Directo a Mexico. There is a channel between the US Central Bank and the Mexican Central Bank which offers a guaranteed exchange rate. Fantastic. So there is no currency conversion problem in there. But for almost all, well, there are. The US Fed used to have a number of these channels, but they've been shutting them down recently. And almost everywhere else in the world, there are no such channels. No one will guarantee the exchange rate. So someone, somewhere, has to bear that risk. And this is true for DLT solutions as well as fiat solutions, as long as the funds are eventually spent in fiat. At some point, they need to be converted. And the problem with settlement is that settlement happens at a particular time, and therefore, you have to be able to settle at that time. You can't wait for a more advantageous exchange rate. People want their money. So, who might take an exchange risk? Well, commercial banks might, and this is how things work now. But costs are very high for developing economies, and commercial banks frequently say they're not interested in small payments. So, there are lots of corridors in the world where you really can't get commercial banks to take on the exchange risk. It's not just the exchange risk, but so, central banks, well, the problem with central banks is that their operating rules typically say they can't take risks, which is a bit of a problem for currency conversion. And we've certainly, in the COMESA system that I talked about earlier, we tried to persuade the central banks to manage the currency conversion. And they said, oh, no, sorry, our statutes don't allow it. Foreign exchange traders, maybe. But their business model is about avoiding risk, except where they see profit in it. So they will be expensive, and the more difficult the currency conversion, the more expensive they're going to be. And those are the poor countries where we can least afford to impose high cost burdens on people. In the end, it's the customer who bears the cost, one way or another, except central banks. If central banks did it, the customer wouldn't have to pay the cost. But in all of the other models, it's the customer who pays. And as usual, the poorest customers pay the most. So we need to do something about this. Or we need to try to do something about it. So, there are two models, I think, for settling currency conversion that remove exchange rate risk for the poor. The first is that for some third party, like a central bank, to assume the risk. As we've said, there are legislative reasons why that's difficult, but nevertheless, it might be that that's a way that we could go forward. The other one is for each conversion to be settled immediately it's executed. Now, in the financial world, this is called real-time gross settlement. So it means every transfer is settled as soon as it's executed. In the long term, I think that only the second of these is viable for financial inclusive systems. And that means that we need a settlement method which is available 24/7, cheap enough to meet the G20 requirements for cross-border payments. And you've got to remember that this has got to be at the packet level, because if we're packetizing our payments, we're going to have to settle each one as it happens. We may have to. So, that's an introduction to cross-border payments and settlement and exchange rate risks. I want now to think about the legal aspects of international payments, which are also problematic. Oh, I'm going to move fast. So, legal requirements for a cross-border payment are that you must reliably identify the parties to the payment. That is, the person who's making the payment and the person who's going to benefit from the payment. Why do we do this? Well, we need to confirm that these are not bad people, because we don't want them using our financial systems, do we? Now, who needs to do this? The answer is every institution which participates in a payment. So thinking back to that model of the payment that we looked at before, that means all four of those institutions, at least in principle, need to make this check. They need to verify for themselves that the people who are making the payment are are people who can legitimately either send or receive that money. And that means, as I say, every interledger transfer for an international payment. You might ask, how is an interledger payment identified as an international payment? And my answer is that I don't think there's an obvious way of doing that at the moment. But we'll leave that aside for the moment. So how do people evaluate? How do institutions evaluate parties? There's a general statement of requirements, which is produced, you may have heard it mentioned a couple of times, by the Financial Action Task Force, FATF. They produce a series of recommendations for what information should be required in order properly to evaluate whether someone should or should not be able to receive or make a payment. It's produced by an international body, which is good. It defines content, not structure. So there are no standards for API definitions, for message definitions, or anything like that. It just says you should have something like an address. Now, obviously, in order for two institutions to communicate with each other, they need to have a shared definition of what an address is and what it looks like. But FATF doesn't provide that. And there are also, you might think, that people would say, well, there's a size of payment, which might be an interledger packet, below which, or sorry, limit, below which you don't have to do this because the payment is not large enough to require it. Now, there is some talk about this in the FATF regulations, but it's not, A, it's not properly defined, and B, it says people decide to apply this lower limit or not as they please. Also, the lower limit is very high, actually. But anyway, so when you send a payment through multiple parties, you have no way of telling in advance which parties will require which bits of information, or indeed whether they will evaluate the people at all. So it's an area of great uncertainty. Each participant is evaluated then by their local regulator, and of course regulatory requirements may differ. Some regulators may require a date of birth, others may not. So there's no consistency between regulators, and as far as I'm aware, no effort to arrive at a global standard between regulators for payments. And penalties can be very significant. Typically, of course, for small payments, they're not. But paying people you should not pay can attract a very large fine, and in some cases jail. So it's probably worth saying that parties have an incentive to fail payments, which is not good news for the poor. So information, generally speaking, about the parties is contained in the message payload itself, and it needs to be in a form which can be processed by every participant. That's a problem because, as you're aware, if you think about interledger payments and those kinds of things, they will be passing through all sorts of institutions. Same is true for Mojaloop payments. And if you're concluding personal information about the people who are making the payments, such as their address, their date of birth, their full name, those sorts of things, then there is often a very significant conflict with the rules about data privacy and data sovereignty. Not only that, it places a very heavy burden on small and informal institutions who may be getting paid by people and therefore storing information about people from jurisdictions where privacy laws are extremely, privacy laws are extremely detailed, let's say, and where the requirements to keep personal information safe are imposed on anybody who receives that information. So at least in principle, you can imagine a small credit union in Angola being prosecuted because they don't take proper care of information about a payment from someone in France. So that's a problem. We need to have a standard form. Now, there are standards, and the best known standard, I think, is one that's called ISO 20022. The International Standards Organization has a set of definitions of messages for all kinds of financial activities. So that includes payments, securities, large-scale foreign exchange trades, all of those kinds of things. It's a standard which was developed by international banks, and therefore, as you can imagine, it really helps international banks, but is not so good for us. We took a decision in the Mojaloop Foundation about 3 years ago, something like that, that we need to engage with this. It's more and more clear that people who are implementing payment systems, and regulators who are implementing payment systems in particular, want to insist that those payment systems use ISO 20022 messaging, which may or may not be a good idea, but they're definitely doing it. And there are institutions like the World Bank who will not provide funds for the implementation of systems unless those systems use ISO 20022. So the Mojaloop Foundation joined the International Standards Organization, the ISO 20022, and since then we've been pushing for the extension of the standard to include the things that we think are necessary to provide a proper, inclusive payment system set of messages. It's also problematic because those messages are currently defined as XML documents, though there is an initiative going on in the ISO organization at the moment to provide a JSON version automatically. There's an underlying data dictionary with a tool which converts that into an XML definition. There's work going on at the moment to provide a similar tool to produce a JSON representation of a message. And there is also a group looking at API definitions. So they're kind of moving gradually in the right direction, but it's a slow process. I can tell you that the first time we made these proposals, the first 7 or 8 times we discussed them, everybody said, well, why would you want to do that? So we would explain why we wanted to do that, and then we would have another meeting after people had gone away to think about it, and the first question they ask is, well, why would you want to do that? But eventually, we got approval for the changes. So some of the changes, including, I'm happy to report, inclusion of the Interledger packet version 4 into ISO payment messages, will be coming out in the standard in spring of next year. You can also tell that this process is not a quick one. But we are engaged with it. And one of the things that I want to say is if anybody particularly people who are representing payment systems, are interested in getting involved, the more we can go to the ISO organization and say, look, there are lots of people who want this, the better it is for us. So it's a long process, but we are succeeding. Watch this space. And that is really all I have to say, almost. So payments need to be identified as cross-border, and the DFSPs who receive payment execution messages need some way to understand whether the payment requires them to compliance check or not. And this needs to extend the ILP Rafiki standard, I think, because all DFSPs need to be able to process it. So if Rafiki messages are being processed by financial institutions, there will need to be some standard defined to say, here is how compliance information is represented. And cross-border payment messages need to include compliance information. The alternative would be for all Rafiki ILP messages to include compliance information in the standard form. And that may be required in any case, because there's no guarantee in advance, as you heard from Stefan's original presentation, no guarantee in advance which jurisdictions an ILP payment will go through. So what are we standardizing? Compliance information isn't used to demonstrate that people are who they say they are. That's often said like that, but I think that's not true. What it does is basically it exposes the account holding institution's evidence that this person can legally, or this entity I should say, because it could be a company, can legally participate in a payment. And for each intermediary who evaluates it, the evidence substitutes for trust in the institution which holds the entity's account. So what it's essentially saying is, if I were presented with this KYC with a customer, would I allow them to make this payment? Now, this works well where basically the intermediaries are of the same type and hold the same type of information about their customers. When the parties are very different, so for instance, when a customer of a bank in Europe or the US is sending funds to a customer in Togo, not so much. Is there an alternative? I'm going to say quickly. We assume that payments can only be routed between accounts which are held at regulated institutions, eventually. And the regulator of each regulated institution is discoverable by other regulated institutions. Now, when we say, where does the regulator derive its regulatory authority from? It's generally speaking a superior jurisdictional authority or an authoritative international body, as it might be FATF or whatever. And this is really surprisingly analogous to the derivation of authority in a public key infrastructure. So keys are issued by a certificate authority, and information about the certificate authority which issued the key forms part of the key. If the certificate authority derives from another certificate authority, then the derivation path can be ascertained, and eventually you can work back to a certificating authority which you trust. Then the certificate can be accepted in lieu of the evidence. If not, not. And that's all I have to say about the miracles of high finance. Does anyone have any questions? Is there time for questions even?
I would say no, but with all due respect, we have time outside, no? We can take questions outside in the break.
Well, that's true. I will make myself available.
If it's not too much to us. Thank you so much.
It's my pleasure.